we're going to just jump right in. And let's talk about, Vikas, let's start with you. Let's talk about pipelines. And what kind of effect has COVID had on your pipeline? And what does it look like for over the next 12 months? What are the key drivers impacting decision-making process, and have those changed?
Okay. First, good afternoon, everyone. Thanks, Todd. Thanks, everyone, my colleagues, for being here. So Omega's pipeline. So as we all know, everyone in this room, there's a lot of deals out there right now. And so we continue to look at everything that's out there, but we're looking at it more conservatively now. We look at them more carefully. We try to make sure that there are markets that are good, operators that are strong. There's not a ton of competition. So we just look at everything with a little bit more of a conservative eye. Now, when we say pipeline, some people say actionable pipeline or just deals to look at. I would say in the COVID environment, which I think a lot of people here would agree with me, is there's a lot of deals still. So we continue to look and look and look, but there's a ton of capital out there. And I would say Omega, we are the largest skilled nursing owners in the country, but we like to look at things conservatively. And the most important thing to us is our operators. So we continue to underwrite to our operators, and the best deals are the ones that come from our operators directly to us. So if we trust an operator and we know it's a good deal in a market that they know well, that's a slam dunk for us. If it's a new operator, new market, it takes a little bit more, underwriting, a little bit more getting to understand the assets and what's going on. I'd also say, just jumping to the underwriting in general, it's tough to underwrite deals right now. You got to look at 2019 performance, pre-COVID world. You got to look at a little bit of post-COVID world, what's going on. You got to see what was going on, and I'm talking skilled nursing for now. You got to look at what's going on with all the stimulus money, because the idea was that stimulus money made everything status quo. Well, what would an operator be doing without stimulus right now? How would that be underwriting? And you got to always plan for the worst and see what would happen if that stimulus money wasn't there. So I think in general, I would say the pipeline's there. There's a lot of deals out there. It's just about how you underwrite them, and we at Omega are being a bit conservative right now.
Very good.
I'd agree with a lot of that. I think pipeline, I think we saw a lull in things as soon as the pandemic hit. People weren't really sure what was going to be and how it was going to impact the SNFs. I think in general, there's certainly a lot of deals out there now, but I think we're seeing a lot of distress already hit the market. I think it's kind of, even with, I guess, the deal activity we're seeing now, I still think it's the silence before the storm. Like Vikas mentioned, the stimulus money seems to be keeping people afloat for the time being. But the question is, like you said, what happens when the stimulus is gone? Not just how do we underwrite without the stimulus money, because I think that's what's getting a lot of people through. Haven't seen many deals recently where a P&L has any sort of a, EBITDA positive on a P&L basis. The balance sheet's got plenty, but the P&Ls don't look very pretty. For us the outlook on kind of, let's call it Q3, Q4, I think we're going to see a lot more deal activity, but I think it's just going to be a lot more distress. Fire sales, we haven't seen pricing come down. Market's flooded with capital. Everyone wants to get their hands on deals or look for opportunities out there. But from an underwriting perspective, very much like you said, there's a lot of things to be careful of today. Not every broken toy can be fixed, figuratively. There's a lot of buildings out there where I think we're going to have to start getting a lot more creative. We've seen portfolio deals in rural markets that have come up where I think consolidation is the only play. I'm not suggesting that rural markets are, a dying entity, so to speak. But I think that rural markets are something where people are going to have to get a lot more creative, and not every distressed facility running a low census where there's very little population can be fixed by opening up a psych unit or by going the dementia route. It's just not that simple. Especially in markets or markets or even operators, sellers who were distressed pre-COVID. We go back to 2019, if operators were already struggling, I feel like it's all the more so in today's market, where I don't know that there's going to be necessarily a path to success in those buildings or in those markets, and I think we're going to have to get a lot more creative, a lot more conservative, and certainly our approach too has become a lot more conservative, and I think we're focused on a lot more primary markets where we see the growth in the demographics. I think that's kind of the outlook that we have. Very similar to yours, but I think, like I said, I think the deal flow is going to come end of this year. I think we're going to start seeing it happening, assuming there's no more stimulus on its way. But those are the key drivers at this point. But we're still out there, we're still buying, and thankfully during COVID, we were able to quietly sneak in close to $1 billion in acquisitions in the midst of COVID. And we're going to go after. We've stretched our criteria in different ways, looking at different types of deals, willing to pay up for certain types of deals that we wouldn't have before. But as historically distressed guys, we've had to broaden our horizons and kind of look at the full view and what's going to survive the long term.
I'm on board with everything that you said. I'm seeing a lot of consulting work right now where a lot of people don't want to sell. They have been in the facilities for a long time and have no idea how to fix them. But as things are coming to market, I think everyone is trying to get their facilities out on market before there's just a mass influx. But kind of like when you're selling off stocks, I think it's going to pick up, and you're going to see absolute tremendous volume coming up. I think a little sooner than you. I'm thinking probably 3-4 months from now. There's too many facilities right now that need a lot of help, and to rebrand, I think the relationships that a lot of the facilities have had with landlords over the years, they were able to just have debt service coverage as long as they were able to maintain, but not many of these operators are able to fix what's broken now. And so a lot of that stuff is going to have to be re-tenanted or come back to market. And I think it's going to happen pretty soon.
A lot of the mom and pops and the local small regional operators, a lot of those guys weren't doing well pre-pandemic, and at this point they need a lot of help just to get some guidance. And we don't see them here at ECAP either. A lot of those operators don't have access to the information, the consultants, a lot of the what the bigger operators do, or not even necessarily bigger operators, just I guess more the operators that are more well tuned in to what's really happening out there. Thankfully we've focused on really targeting operators that are regionally focused. I think that's the key. It's what I've seen from Vikas too. Of course, the Enzymes of the world and some of the larger operators that just kind of get out there and really just, kill it out there in the market. Those kinds of guys will do business, we do business with them too, and that's a great relationship of ours at Cascade. But I think those smaller focused operators is where we're starting to see a lot of success and where we've seen success over the last 5 years, and I think those guys are going to continue to see the success because they've got their ears to the ground, and those types of relationships that we have in the different regions, what we're focused on at Cascade is really trying to expand the relationships. We've been very successful and seen a lot of success from guys, even some of the new guys out there that have come about in the last 3-4 years that were, successful regionals for other companies that wanted to go on their own. But these guys are really tuned in and really following, keeping their finger on the pulse of everything going on in their markets. And sometimes they're going to be the first guys to hear about the opportunities from some of the smaller mom and pops and smaller regional operators out there. Those are actually the deals, and the opportunities that we like very much.
So
yes.
Todd, I think your question was deal flow, which deal flow for me, by the way, Yitz, your time's up. So deal flow for Meridian means something a little different than for the owner operators on this panel. I'm in an advisory capacity, so I'm placing debt and equity. So for us, interestingly, COVID has been an anomaly for us, right? We've actually seen more deal flow through COVID. We had our best year last year as far as deals closing throughout COVID, which was kind of scratching our back a little bit. I did get more gray hair through the process, but there's been a tremendous amount of deal flow through COVID, and how those deals are getting done. I'm sure we'll talk about it a little bit more in the panel later on in the panel. But the SNFs versus AL, how we're seeing SNF deals continuously getting done versus AL, which probably took a pause for a little bit. But yeah, I mean, the short term, at least for us, is that deal flow has been super strong, and I guess we can touch on it a little later in the panel why that is. And with that, Todd.
Actually, why don't we stay on that right now for you? Just in terms of the debt markets have been challenging. Everyone knows that. What are the biggest challenges that you face, and how did you navigate them? Because you got deals done, and then what do you think is going to happen 6 to 12 months from now, over the next 6 to 12 months?
Sure. So I think the hardest deals on the SNF side that we've had to navigate are deals that, the typical, here we're at 50% occupancy and, but we're going to do X, Y, and Z, and suddenly it's going to be 95%, right? And I think a lot of even super strong operators are struggling with low census, right? And so we've had to get creative, right? I think that historically, the deals that we've had an easy time getting done are expense cuts. When there's a provable sort of methodology where this is what we're going to do, here's our past experience, and now we're going to, do it again in this particular portfolio. That's something, it's a bit of an art, but it's something that we've been able to paint the picture for our lenders. If it's just census, the whole country's struggling, and that's by far been our biggest challenge. How do you underwrite those deals? How do you sell lenders on those deals? So we've had to get creative. During the height of COVID, a lot of lenders took a step back. A lot of the guys that we really leaned on over the years, and we trusted, and we kind of slept at night to say, hey, no matter what, they're going to close these deals. They stepped out of the market, and that didn't mean our clients stepped out of the market. Like I said, we had a great year. So what do we do? So yeah, I mean, we got creative. We leaned on a lot of finance companies that are able to underwrite to that risk. They're a higher cost of capital, but you know, they get deals closed. But B, we did a lot of senior plus mezz deals, right? Get the senior lender super comfortable at a super low basis, bring in a mezz piece, add on that sliver, and get the deals done that way. Shua.
This is your wheelhouse more than
Oh,
mine.
okay.
Yeah.
I can continue talking.
No, you're good on this
I'm just
one,
upset that Vikas wore a louder jacket than me.
You know,
Go for it.
I was just going to say, I totally agree with you, Ari. It's, you know, Omega, we generally are buyers, but we occasionally sell. Going into the pandemic last year, I probably had a half a dozen buildings on the market for sale or signed up, and I thought those deals were going to fall through, but different lenders stepped up. There's a lot of capital out there. And I think you said it perfectly, Ari. Some lenders took sat back, and other lenders got aggressive. I think that's what kept the deal flow going. And I think it's pretty, awesome. And now we've got, some of those old lenders are coming back. Everyone's trying to underwrite the same ways, understand what's going on, and I think a lot of it goes back to once you have a trusted client, they hit a home run, we can back them again. We're good with that. We can understand their expense cuts. We can even buy into maybe some of the upside that's going to come post-COVID. So I completely agree. I mean, debt markets don't affect us at Omega so much. We've got our equity and our bonds, but as we sell, I have to say that I haven't seen a lot of shakeup on our sales.
Yeah. Deals are getting done. We're very thankful for the lending partners we've had. Ari can speak to, Ari and their whole team, did great by us during the pandemic, surprisingly. We also had a lot of fear of whether things were going to kind of pan out. Early on, we saw those term sheets that were coming in at super high rates, just didn't make any sense. I mean, there's just, in the world that kind of we function in, obviously you don't have the same parameters, but the world that we function in, where leasing buildings out, and third-party leases and stuff like that, we were seeing term sheets that we would just never agree to. But certain lenders did step up, and one change we saw was that it wasn't necessarily deal-based always, right? Two guys can come with the same deal, with the same pro forma, but the banks have a certain trust level with repeat clients or a certain track record, and it seemed to us like banks that wouldn't necessarily lend to somebody else were ready to come to the table with aggressive term sheets for us and actually execute and get things done because we have the track record, we have the relationship, we've proven out our model, so to speak, and that was, thankfully we were able to kind of bring some things home. So
There's no question that relationships matter in this business, right? And I think that even in my capacity as an advisor, right, we work really hard to paint the picture to the lenders of who our clients are and to work on those interpersonal relationships. Because without those relationships, certainly when things are good, you need them, but when things are bad, you definitely need them. And we would be doing our clients a disservice if we didn't work really hard to make sure that our lenders know our clients and vice versa really well, and that there are issues. Almost every, even really good skilled nursing operators have issues, and you have to be able to be upfront with your lenders and say, this is what's going on, and here's how we're going to tackle it, right? And I would just add that one other thing that we've seen I think a pretty notable change is recourse, right? We did a lot of deals non-recourse pre-COVID. Throughout COVID, recourse has become, even for the traditional non-recourse lenders, they've still wanted a sliver of recourse, if not more. Certainly during the height of the pandemic, but even now, some of those lenders have gotten pretty comfortable with having that sliver of recourse and are still insisting on it. But as the market gets more robust and more capital comes in, I think that's going to change in short order.
So a lot of times when I underwrite deals, I actually underwrite census. That's my primary way of flipping buildings. And certainly if I didn't have the relationship that I have with the banks and the lenders, we wouldn't be able to get those deals done. I'm not very good at expense cutting, but I can fill a building up, and so that's tough to sell to banks that you don't have a relationship with.
And Shua does a damn good job at it, by the way.
Yeah, sure. I need more banks. Thanks, man.
Yeah.
All right, Vikas, let's move back to you. Where are you seeing a difference in skilled nursing acquisition world versus seniors housing space?
Well, I think it goes back to something Yitz said, where there's a storm still to come, I think, especially in the senior housing side. We've all been looking for broken senior housing. I have been looking for a lot of broken senior housing. I haven't seen it yet. I still think it's coming.
Right.
So, that's senior housing. On the skills side, I'd say there's just a ton of demand for deals by everybody. So I'd say this, honestly, I think more skilled deals have happened over the last year than I would have ever guessed going into this pandemic, ever. Mega deals, small deals, you name them. So I think, basically I'd say SNF is status quo in a way, and it's a little bit unbelievable to me. But the senior housing world is coming, I think. With that said, there's been some large senior housing deals out there. As we all know, HealthPeak exited or is in the process of exiting their portfolio. There was a lot of deals out there. Omega, was the beneficiary of one of those deals. So, I think, generally there's a lot of deals out there, but senior housing still to come.
I would agree entirely. I'm shocked by how much status quo has just it's really just been incredibly consistent throughout the entire, maybe a 2-3 month break in between, but throughout the entire pandemic. The demand out there for SNFs right now is just, it's nonstop. I get multiple phone calls a day. Everyone's looking for deals. Everyone's trying to find some buildings to get their hands on. I don't get it. We don't understand it per se, but nonetheless, I think that the level of distress is just gonna, the storm is coming. There's no question.
And I just had one more comment.
Yeah.
On the senior housing side, I'd say private equity is playing a big part in that still. They're your buyers for a lot of the products out there. The big deals, they want to put out some money. I think they're still paying up for some of it. I think some of the operators are focusing more on skilled. That's where they are, and I think that's where, hopefully, as senior housing breaks a bit more, or if there's price cuts, that's where other people can get involved in that. But I think right now senior housing has been gobbled up by a lot of private equity.
All right, so Yitz, with the number of assets coming to market increased, should you be buying? And just a quick follow-up, is it better to keep a regional footprint versus expanding nationally?
So I think it goes back to what I said before. I think certainly there's opportunity in every potential skilled nursing portfolio or transaction that could be out there. There's opportunity in it, but a lot of it's going to be based on the operators, right? So I know at some point people want to hear me say what markets we're bullish on and where we want to chase deals, and I guess the real answer truly is where there's good operators, where we can find a quality operator that's really focused on, I guess the truth of what this business is there to do. I think those are where we're going to find a lot of opportunities. I think as more and more buildings come to market, should you be a buyer, I think you got to know what you're looking at. Not everything is the same. Not every market is the same. Certainly by us, we have an amazing team. Some of whom are sitting here. Some amazing analysts. We've got some great guys on the team. A lot of you guys know the other team members. It's not, I'm just one of many by us, and some just incredible heads, incredible minds. But we've been making a big push and really focusing on the data, trying to really get a full grasp on which markets have that survivability, have that long-term potential. Not every deal that comes to market is going to be a deal that can survive. And so I just think that it means, should you be a buyer, I think you got to look real closely, really focus on the details, focus on the potential of the market long term. I think that I think that if you're a good operator and you can get creative in some of those instances, I think that even the real distressed assets out there can be turned around with some real creativity. But I think there are going to be those, like I said, that consolidation may be the only play, and when that's a part of the picture, you got to remember that when it comes to valuations. You can't pay the same number per bed if you're planning to shut something down and consolidate patients into one area. And I'm not, the workforce, it affects the workforce out there. People lose their jobs when buildings shut down. There's a lot of things to consider. A lot of the small towns and rural towns out there are not happy when you come to shut down buildings. Sometimes they're the largest, if not the only main, real employer in the town. These are unfortunate things that may just have to happen because there's going to be buildings out there that are not financially viable. So
I'll translate for Yitz. You should buy, but only if it's from Cascade. That's the summary.
I think that operators have a lot of leverage right now with the amount of buildings that are going to be coming to market. Don't bite off more than you can chew. Just because there's a big portfolio out there and you can walk in making some money or it fits your footprint, I think you should take your time and find something that you're really passionate about, something that really fits, that you can really perform at a very high level. And I think that especially with the amount of stuff coming to market, the amount of busted deals, flushed equity that's going to happen for sales, we're going to have to work very closely with lenders and REITs, and I think we're going to be able to be very creative to create more upside for operators. So I know that I'm taking my time and just looking at everything very closely, and if it isn't a home run, whereas normally before I would go for a double, now it's got to be a triple. That's my perspective on it.
So I would also just add that geography plays a pretty big role in this discussion, right? Because there's states like New York and Maryland, there's discussions of minimum staffing ratios and, maxing your profit at 5%, and I don't know where that goes, right? I think that eventually that's gonna have to, like a lot of things, go away, because we need skilled nursing. It has to survive. But for the short term, there's some headwinds, and depending on the state, those headwinds are pretty significant. So, there's certain states where we have deals, and in a quiet capacity, we place a lot of deals, right? And it goes without saying, we have a deal in Maryland. I don't lose sleep. I'm going to get 5 LOIs in it within 12 hours when I go to sleep, and I'll have it in my inbox in the morning. But then there's states where people probably should be careful, right? And census is hurting, and it's interesting. I'm not sure if you guys saw this, but Indiana, I saw had the highest death in the entire country, right? In Indiana, and that's interesting, right? Because that means that census in Indiana is probably going to be difficult to rebound, right? And in more urban areas in New Jersey, even though we got hit pretty hard, we think that I would suspect. I don't claim to be an expert, but I would think that census is going to rebound a lot quicker. So we'll see.
To your point about Maryland, I'd say even in a place like Maryland where you're going to get 5 LOIs overnight,
Yep.
right? Not every building is the same in
Cascade's
Maryland.
not always the highest, but usually. Yep.
What was that?
I said Cascade's not always the highest, but usually.
No. Thank God we get deals not being the highest bidders, because we're close. But that's a different story. But not every building is the same in Maryland. It just isn't. I mean, a lot of guys are coming in, and I see it from a seller perspective too. Sellers are looking for numbers that they see or that they hear people are getting. Maybe they got the skilled nursing news, email in the morning and woke up to it and see somebody paying $170,000, $180,000 a bed in Maryland. And they're expecting those same numbers. And the truth is, out in the Eastern Shore, some of the rural markets within Maryland, the rates are not the same, the staffing is not the same. I mean, there's a lot of factors to consider, and I think that's really, kind of our point, being that Cascade is really an entity that's, kind of a sister company to a true operator in both urban and rural markets between Chicago, South Dakota, and some other places. We're really focused on, as operators, how to really staff these buildings. What's the true potential here, focusing on the rates and the reimbursement. And I think that's the level of detail that's necessary to go into the deal market today and to be able to decipher between an opportunity or something that should be a quick pass.
I think every city has winners and losers, and I think irrespective of what's going on, outside of maybe a cap on profits, but you can do well wherever you are if you have the right asset and the right game plan. I operate in non-CON states where typically a lot of people from California are coming into Arizona and Nevada where I operate, and with construction costs going up, new construction is slowing down. So I'm pretty happy about it. It's going to fill our buildings up just with sheer demographics over time. But I'm not scared of any state. I think it's, as you said, there are some deals that are just busted. So those deals, obviously, but if the business is there, and I operate in urban markets, go get it.
If you have a large enough building where you can make room for more private rooms, I think we all know what's coming. Patients are going to want private rooms coming into SNFs. The stigmas against SNFs, for better or for worse, they're going to remain. And I don't think we can get rid of them so fast. And when you have some of those larger buildings that can give you a little bit more flexibility on how you're housing your patients, if you have more units, you can open up more of those private rooms and give, I guess the more discerning customer or client, patient of today, give them what they're looking for in order to just kind of make things work for the time being.
Yeah, I think it's more building specific than state specific for myself.
Absolutely,
for sure.
yeah. CON states are definitely a concern. I think that from our perspective, we look at CON states, there's always going to be that looming risk of CON. And as more and more buildings potentially shut down or start, I guess, shifting patients from one building to another, there's always that possibility that coming out of this, some of those older buildings that just can't be fixed, there may be new licenses entering into the market,
Yep.
new CONs being issued, and replacement buildings coming up, and these are all things that, I think you have to know your markets in order to be able to know what's going on.
All right. Did you want to comment on states that you're looking at?
Me?
Yeah.
Well, first I just wanted to reiterate what you all said. Regional operators, I think that's the play. A given operator knows their markets, they know their reimbursement, they know the regulations. You take a guy from Washington, you put him in Oklahoma, it's tough. It's tough to make that work. So I echo that. I think all of us said that. With that said, there's some national operators that do it well. But that means they know what they're doing in those states because they have a local presence in each of those states. In general, Omega, we love the Southeast. We think it's great. Demographics are great down there. We think it'll keep growing. We think it'll be great. We think the Northeast is tough. Regulations are really tough in the Northeast. So, I mean, but you couple any of those states with a given operator, you can make it work. Or you might not be able to make it work. Another comment I would make about just buying in general, like, be careful if you're buying and things are at the top, because there's nowhere to go but down. I think a lot of people look at something, they're like, wow, this is great, it's cash flow, it's awesome. I'm gonna take cash flow higher. Sometimes there's not much to do there. Sellers are selling because they're at their peak and they wanna exit. So I just, I warn people to be cautious sometimes. Don't overpay, just thinking you can do more with a given asset.
Okay. Shua, skilled nursing world, there's a lot of talk about home health. You want to talk a little bit about the impact on that going forward?
Yeah, I remember a few years back, I started seeing a big shift between long-term buildings that typically would run 10% skilled, now we're going down to 5%, and the short-term buildings were dominating that market. And with home health being a big part, especially with COVID, they want to send patients right home. I think a lot of the long-term care buildings are seeing even less skilled mix, whereas the short-term rehab buildings are still getting whatever is available for them. I certainly think it's prudent for a SNF outfit to have a home health component. I think it is smart. I know one of the things that we do is we have a person that calls every discharged patient, and we've brought back hundreds and hundreds of patients from the home health setting to the SNF before they end up in the hospital. So having relationships with home health has been real key for us, and especially if it's your own home health, you can control the clinical component to make it real smooth. Yeah.
I do a fair amount of senior housing, and I think that in the senior housing world, home health is a much larger threat, right? Because a lot of independent living or assisted living clientele have optionality. Theoretically, we can engage somebody with home health, and not force our parents to necessarily go into a community, right? I think skilled nursing is necessary. I don't think it's going anywhere, right? 24-hour care, even home health is not going to do away with that industry, and it's cheaper than a hospital. And so skilled nursing is here to stay with or without home health, my opinion.
I'd say just to the operators in the room, I mean, we've all seen over the last 5 years, I think operators have been feeling it the most, that SNFs are not the same as they were 10 years ago. I mean, just from a level of acuity and complexity on the patient side of things, the services that you guys are all required to deliver in your homes are like mini hospitals. We've been saying that for a while. Home health is a threat, but it's a threat that's going to take away a subset of the population that needs SNFs that's already been going away. It's not a solution for somebody that truly needs complex medical care on a 24-hour basis. And SNFs are already heading in that direction, being required more and more and more to perform like a hospital for a fraction of the reimbursement, which is why, we all know that things need to change on the reimbursement side of things. There needs to be some sort of reform to come to make this more of a viable business for the long term for skilled nursing operators. But I think that it's a threat. It's a threat only to that percentage of patients. I think the government's tried to do this before, make a huge push into home health over the last 5 years, and it's been proven it is not a cheaper. It's not a cheaper option in terms of actual dollars spent on caring for patients, because then you have to deal with rehospitalizations that they also have to cover. You have to deal with readmissions into SNFs. It's happening anyways. I would say that home health is certainly an important component, both in senior housing and in the SNF space, in order to just potentially capture that subset, again, that specific percentage of your patients that may be better suited for those types of services. But I think long term, this silver tsunami that we've all been waiting for it's going to happen. But I think COVID set us back by a couple of years, and so I think it may be delayed by 2, 3, maybe 5 years, where we're really going to start to see that big wave of patients needing skilled nursing care. But I think in 5 years from now, skilled nursing facilities are not going to look the same as today. I think regulations are going to change. The requirements of patients are going to be more the private room style. I think it's really higher complex, really, I guess, greater severity of complexities and higher acuities coming into the SNFs. That's really what I think is going to be the push as we move forward.
You stole everything I was going to say.
Sorry.
Just said differently, your average Medicare rehab resident, 24/7 care. You cannot go to a lower cost setting than a SNF. The government realizes that, that product needs to be there. It is the best product out there for that rehab resident. Home health is going to be part of it. It's a big buzzword right now. It's going to be part of the continuum going forward, probably a bigger piece of it, but they cannot replace what we do in SNFs.
I really do want to stress what I was saying before. I think that home health, for the long-term care buildings, I think home health is actually going to take a lot of their pie.
Exactly.
Yeah. The short-term care buildings are, the winners in the market are going to be full. It's that overflow that is going to be wiped out.
Okay. All right, let's bounce back to you. You were able to finance some deals that had horrible census, 50% occupancy. That's nothing short of a miracle, in my opinion. Do you still see the market chasing those deals, and how are you handling that?
Yeah, so I think we touched on this a little earlier, but really, the market is red hot when it comes to skilled nursing deals, and that's nationally, right? I think that there's a lot of capital that's chasing skilled nursing, and it's interesting actually to contrast that to assisted living, and Vikas can probably speak to this the most on this panel. But I spent a fair amount of my time in senior housing, and senior housing, the world came to a complete stop, almost a complete grinding halt with the onset of COVID. And we have not experienced that at all in skilled nursing. So will the time come in the near term future where, PPP money runs out, and there's a lot of operators that got, artificially boosted up by PPP, and that's done wonderful things to their balance sheet, like Yitz pointed out before, but P&L not so much. And so, yeah, I think that will start changing in time. But, the sales market remains tremendously robust. There's a lot of capital that's chasing it. Thankfully, debt has remained super active, with some, conservatism that has also, come into play. But if you're somebody with a track record and somebody with, a balance sheet behind you, you're going to get your deal done. I think the harder part is for the young guys that are trying to come in and buy turnaround deals, right? It's not to, look at Shua, for example. Shua has three facilities that are extremely profitable. I think you just hit 100% occupancy, and
For months at a time, we were 100% full.
for months, which is unheard of, right? And Shua's business is, I don't care if I have 50 facilities that are at 60% occupancy. I have 3 facilities at 100% occupancy, which is a huge feat, right? And I think that, there's a lot of young guys that come into our business and say, wow, how many, even at this conference, right? How many facilities do you have, right? And it's just seemingly to me such a silly question, right? Because it's not about how many facilities you have, it's how profitable you are, right? We're all here to earn a living and pay for our wife's shoes, right? So at the end of the day, this market remains super robust, but just caution as far as where you're buying, that we've discussed earlier, what states. Massachusetts, as an example, has been a state where we've seen a lot of people fleeing, right? The state has been pretty tough on a lot of new regulations, tries and quads. If you have them, you can't have them, minimum staffing rules, and a lot of people just cannot navigate that state, including some really smart operators, right? But, like we say, when everyone's running that way, sometimes there's opportunity there too. So we've had some clients that have pursued it, and in my opinion, are going to do very well. There's upward rate pressure, and although it might not be the sexy state to buy right now, excuse the French, but I think that state is going to recover because ultimately we need facilities in Massachusetts just like every other state does.
Yeah,
I know it's a little
your
bit all over the
downside is
place,
limited.
but yeah.
Your downside is limited when you can buy on the low.
And they're buying cheap.
Like Vikas was saying, I think we can all agree. When you're buying, protecting your downside. That was a big part of how we expanded so fast. We were focusing on the distressed assets where you know your downside. You buy at the peak, buying all the performing assets, and that's where Omega really is just different than a lot of the other REITs out there. That's why me and Vikas butt heads on deals a lot of times. Because there's only so many of us out there that came out at the time we did, really looking at the opportunities that have that downside protection, right? You know that if your operator fails, if you're in at the right basis, you can either get a new operator in, or if you have to fire sell, sell off an asset, sell off a portfolio, you know that you can probably get some sort of a floor value for those licenses in any state. So I would agree. Ben Scheib says it in our office all the time. People fleeing from Massachusetts, and I've seen the Massachusetts, headaches firsthand. And Ben says it all the time, that we should be taking a closer look at this state, and maybe now's the time for us to kind of get bullish on something like that. And maybe there are other states out there that are the same.
$50,000 a bed versus $200,000 a bed. That's the question.
Exactly.
Yep.
All right, but sellers have to be realists in today's world, and right now we haven't seen, we haven't seen realistic expectations. There's a lot of money out there, and certainly probably some guys in the room that are looking to get their hands on volume, grow their footprint, continue to kind of build concentration while there's opportunity to do so. But the numbers we're seeing thrown around, and the fact that numbers have even potentially gone up in today's market, where we're dealing with buildings at 50, 60% occupancy, where depending on the market, we're not even sure if the rebound's going to take 12 months, 18 months, 24 months, 36 months. We have we don't really know where this is going to go, because for every one patient coming out of a hospital, you've got 5, 10 buildings in line for that same patient. This could take quite a while. There's definitely operators in this room that I spoke to that have large footprints, large concentration in states that are seeing a precipitous increase in census across 20, 30 buildings of 20, 30 patients a month. That could take a long time to rebuild 20%, 25% of your census in some states. So I think we're all seeing it the same way.
The only building that I've ever taken over with like less than 50% was a receivership deal where they were begging to get out, and that deal moved very quickly through HUD. I know you're saying financing for 50%, and sure, people are going to jump on everything, a lot of upside on those deals. But I would caution everyone, I would pay more for performance now. I think cheap capital makes cap rate compression. Be careful about those 50% buildings. Census is not going to come back so quick.
But I do think the prices will increase in those primary markets.
Agreed.
Where the buildings that you like to operate, those good buildings where you've got a lot of hospital discharges, a lot of concentration of those large hospital systems and so on, I do think that there's potential for those prices to continue to go up, because I think there's going to be a little bit of hesitation on more of those tertiary and rural markets out there. So I think that's also yet to be seen, but in certain instances of recent and deals that we're either under contract to do or some things that we're looking at, we are seeing that in those primary markets, people are willing to pay up more so than they were pre-COVID.
You think we can get 10 caps, 10.5 caps on those performing assets in markets like that?
It's highly possible. In today's world, 10 cap on what? Right? Most of these buildings have nothing there. 50, 60% occupancy.
Well, those
I love that question.
Stuff, yeah.
People come, what general cap rate are you buying at? Well, I mean, if you're buying
negative,
right, there is no cap rate. Well, I'm at a negative 12%. I don't know what to tell you. We're looking at opportunity, and we've got some fantastic people in our office, and great operators and asset managers and people that really know their stuff, that are digging in and seeing what the opportunity is, not what the asset's making, what the opportunity is there. If there isn't an opportunity, we're not the buyers. We're not the guys for it.
Vikas, you have a pretty broad range of tenants, right? So what are your tenants telling you as it relates to census? So is there an optimism in the market?
The crystal ball is the toughest question right now, and when census is coming back. I think, we're, again, just like everything, we're being conservative, and our tenants are being conservative, and they don't think census will be back till next year, and probably in the latter part of next year. Now, again, let's all keep our fingers crossed. I hope it comes back quicker, and I've heard some really good examples lately. People, 75% is a good census nowadays. It's kind of, you hear that number, you're like, wow, things are moving. I think we all want to hear the 80%. That's when we feel like things are really getting back to normal. I just want to go back to something else on this question, which I always feel like it left out over here, right?
It's my fault.
I was just going to say, Omega, we sell occasionally. Again, that's not what we do primarily, but every asset I've sold is a non-core asset. And those are those buildings with 50% occupancy. And they trade, they close. People get the financing, they get the deals done. So I just wanted to go back to the question you asked to start with. I think that's going to keep happening. And I think people are going to find those buildings. They're going to see if they can find upside in them. They're going to go to their lenders that they have partnerships with, and they're going to get the deals done. Okay, now I feel involved.
Welcome back.
Yeah,
You mentioned census, and I think, like I said, like we started this question, geography matters, right? We have a client in the Bronx who went down to 70% census, and last week was up to 93%, right? That's not happening in Kansas. It's just not, right? So it just matters where you are.
Yeah, but I hear it might be happening in California. It might be, there's various markets. And so, again, it's better to be conservative.
Agreed.
And see what's going to happen. But there are pockets. And I bet a few folks in this room could say that their occupancy is normal or 100%. Like stats like that are just awesome. But just Hope it comes soon.
Yeah, there's not enough census to fill everyone's building, but there's enough census to fill your building. That's what he said.
Well said.
All right, let's switch gears just a little bit. Impacts of the new tax proposals, which none of us are specialists up here, but I think you've got some opinions. What do you think it does to the investment market?
I think it's hard to say right now because we just don't know what's going to be. I think if there truly is going to be a shift, we may see an influx of deals or sellers looking to sell fast and get it done before year end. What happens post that, we just don't know. I mean, if there are changes to long-term capital gains and so on and so forth, maybe that means people are going to hold for longer. Maybe that means we start to, shift our model into more of a long-term partnership with our operators as opposed to what we generally do, which is leases with purchase options, which is why, we believe that we've been so successful. Is, even from our perspective as investors, we may have to shift our strategy, and I think that may be a necessary thing to do, but, that just means we're going to be that much more selective of the operators we're going to go into business with. We're a very, people-centric type of company. We're going to focus on those operators that we want to be with long term and that believe are in it for the right reasons and are in it long term. I don't like, I don't necessarily like, the operators that are just looking to, flip it and roll out. It's not necessarily the model. I think you got to be in this business for the right reasons today to actually get the job done and get it done well and have any sort of long-term potential.
I definitely agree with you. I think people are going to hold on to their stuff a lot longer, reinvest into the buildings, and I think it actually might benefit the SNF industry to make it a less risky asset class. If people are going to be holding on to their buildings for a lot longer, they're going to have to. So
yeah, I don't claim
maybe
to
then
be,
we'll see 10 caps.
Yeah, I don't claim to be a tax expert, but I know this much. People don't like to pay taxes. Some way, somehow, they'd prefer not. So at least in the short term this year, we're seeing, we definitely have a fair amount of people that are looking to rush their sales. We want to get out 1031 before it's too late. That's it.
Yeah.
I'd be curious to see the impact on more of the sale-leaseback type of model. I think if there's probably the greatest risk, I think it's going to hit the REITs. If there's truly going to be a difference, a significant difference in either capital gains rates or the viability of 1031 exchange, I think that's where historically, you guys have had a ton of success over the years with the sale-leaseback cons. A lot of those, regional operators that are finally ready to kind of take some chips off the table, but stay in it on a long-term lease basis. I think that's where we're going to see the impact big time.
But, it's interesting. I brought this comment up recently. The sale-leaseback world has been dry the last few years. It's not like most people who want to sell, they want to get out, hand the keys to somebody else. And, I love a sale-leaseback. It's our bread and butter, but there's just not a lot of bread and butter. It's a great deal for us because you get in bed with somebody that sold you the real estate, and then they know how to run those buildings. I'd say over the last 3 years, I just have seen a large decline in that type of those type of sales. I will say one thing that's fortunate for like a REIT like a mega, we can do an UPREIT structure on a sale-leaseback, which means effectively you get a mega stock, which can be can play into your proceeds and your tax planning. Complicated, but it can be done. I would just say in taxes in general, I think there's just a lot of unknowns right now.
It's great.
And a lot has happened over the last 10, 15 years in this industry with taxes. I think, Ari, you were saying a lot of deals are going to get done because of taxes. I think a lot of deals will get done if there wasn't tax changes too. You know what I mean? I just think people when they want to exit and they see all right, Biden's taxes, I gotta hit the button. I think they may have hit the button anyways. Yeah. A lot of times is what I think. But now they just want to force it to get done sooner than later.
Probably not for now, but sale-leasebacks it's an interesting point. I agree with you. We don't see a lot of them. But I also think that part of the reason is you have to underwrite. If you're looking at just a true sale-leaseback, you have to make sure that you're hitting lease, call it debt service, but lease payments with your current EBITDA.
Correct.
And the open market sometimes can yield you a better price. If you're
I was going
just
to say the
getting
same comment.
Yep.
You don't maximize proceeds.
Yep.
And I think sellers have realized that, and they don't want to take on the risk of being my tenant for 12, 15 years when they can just get wash their hands and step aside.
And not worry about annual escalators.
And I won't lie though, I don't mind that either though, because I can take assets and move them to an operator I trust, I already have a relationship with,
right,
and who knows that market. And and if those operators want to exit, and that's also when I can realize upside, or I can underwrite upside. Because if I'm sticking with the same operator, where's my upside?
Right.
100%. And the upread concept is very interesting. I mean, you could expound a little more on what it is, but the upreads, I think, we actually closed on we launched an upread as well, and closed on that during COVID. 16 assets in the pool so far, and I think that's where we're going to start to see, if there's truly going to be some sort of a real tax implication, we might have some people out there that are more interested in taking shares in exchange, contributing the assets into the pool, taking shares in exchange. But right now, it's just tough when everyone's coverage is basically, cut in half because of COVID. So it's like, what am I contributing to? Right? That's the biggest issue. So while we're all kind of suffering on the census side, it's kind of they're kind of working against each other. So yeah, I think but that could be a very interesting thing to come because it hasn't been utilized much.
No, it hasn't. And I think part of it is people see dollar signs versus shares, and
Right.
you need sellers that are sophisticated, planning for future generations is what happens sometimes. And they don't want to take the taxes themselves, but a lot of times people think it's just easier. Let me get the check and let me pay my taxes on it and be done with it. But
Absolutely.
it could have a big comeback.
Okay, I think we got time for maybe 2 more questions. One that gets asked all the time, and we touched on it a little bit already, but let's see if we can put a little more clarity on it, get your opinion. Do you feel the market will be flooded with distressed assets once the stimulus burns off, or does occupancy stabilize in time? To kind of ward it off. So, Vikas, you want to start with that?
Yeah, that's a crystal ball question. I do think there will be more consolidation post-COVID. I think there'll be more mom and pops that exit. I think we're starting to see a little bit of that now. But again, it all goes back to when census comes back. And the other thing everyone knows is that, with there probably not being a ton more federal stimulus money, it's going to get tight maybe later this year. So the question is just, when does census come back? And does it offset it? And if it doesn't, do more and more people just say, I'm out? So, I think it still has to play out over the next couple months to see what happens.
Yeah, I'd agree with all that, and I'd say, you're probably the best person to speak to kind of the getting creative with tenants along the way. I think that right now, guys like us are more focused on rather than just expansion and more opportunity. Of course, when a good deal comes along, we're both going to bid on it. We're both going to try to get it. But I think in the meantime, just working through, what potentially could come about later this year in the distress. It's not just distress, which is going to drive deal flow. It's distress that's also going to make us a little crazy on our side and make, the lawyers and business folks and all them have to figure some things out. And I've seen certainly, to Vikas's credit, over the last few years, you guys have gotten real creative with kind of some other, let's call it other challenges that we're facing the markets and working some things out with tenants and kind of, having to get creative in structure. Something we're rolling out now is, because we really do want people to focus on what this business is all about. I think we're probably the first in the business to roll out some sort of a, kind of a clinical program where we as landlords are going to start kind of giving back credits and rent for, for higher, I guess, quality outcomes and achievements on star rating increases and so on and so forth. And we think that, these things are going to be necessary to really be able to, to find the right operators and to support them and really doing well in today's landscape. It's a challenge out there, and there's going to be distress, and it's, I don't think that all those people should necessarily, close their doors or sell their assets. We just got to figure out how to get them through it.
In certain pockets of the country, there's enough demographics to fill up all the buildings. That's obviously not very common, but like in New York City, for example, I believe that to be the case. I'm of the belief that demographics at some point will catch up, and especially with construction costs going up, which I think will continue to happen because all the millennials are buying homes now, lumber is way up and it will stay that way, that even though there's distress right now in select assets, at some point it won't be. And I think that it really affects your acquisition strategy. Should it be a land grab right now? Try to get as many beds as you can, because at some point they'll be full. Well, if you can float for that many years, sure, go ahead, if that's your goal to do it. But I think from an individual operator perspective, you gotta be real careful with the distress out there. Take your time, choose wisely, only take on buildings that you know you can crush.
Nothing to add. I turn it over to you, Todd.
Okay.
Everyone's hungry, I know.
Right? Yeah, it's true.
I'm not saying I'm hungry, I'm saying everyone else is hungry.
Yeah, no. I would just say, why don't we close out if you guys have any kind of final comments, things for the audience, and then we can conclude.
Okay.
Final
Take it away, Vikas.
Final comments, it's a tough environment, but I think quality operators, good markets, good buildings, this industry is not going anywhere. It's a great industry, it's needed. I think a lot of the folks in this room, a lot of other operators are the ones that make it happen, and I think we're going to get through this. I think the activity of deals going on just shows that it's not going anywhere, and there's a lot of people excited about it, and a lot of people believe in this product. So we do that at Omega every day.
I think COVID even proved it. I mean, COVID really proved this is a vital component to the healthcare continuum in the country. It's not going anywhere. We just got to get through these times. Definitely a challenge out there. Just be smart. And I don't think that, I think that people need to start focusing on, potentially things that weren't necessarily the focus. While you have lower occupancy and buildings, have the ability to shift patients around and renovate some units, money should be going back into these buildings, or else I think that, a lot of those older buildings, those older vintages of 60s, 70s, 80s, these buildings are, potentially at the end of their useful life if they're not well tended to and if they're not well cared for. And these buildings need TLC, right? Patients of today are a lot smarter. Everyone's got an iPhone, everyone's got an iPad, everything. These are, more sophisticated type of customers in today's world, just given the level of technology everyone has access to. And I think that, people are going to want to see some change and some shift happen there. And especially from a regulatory perspective, I think it's going to, when even regulators see that operators are focused on, enhancing what's there, reinvesting in it, not just looking to cash out on every dollar of EBITDA that possibly can. I think that's where we need to be focused now to be able to rebuild this, this industry, to be able to change that stigma, and ultimately see the long-term success of hopefully everyone in the room and all of us together.
I think my biggest thought what's going on now overall is to make sure you have control of your buildings. Yes, it's exciting that there's a lot of deals coming to market, and it might be very easy to scale real quickly. But what happens in a situation of COVID if you grew real quick and you don't have real infrastructure? It's going to be a big issue when you have 40 buildings that have problems at the same time. So be careful. Take your time.
It's very hard to give concluding remarks when I'm followed by, preceded by so many smart people. So all I have to say is invest in Bitcoin. That's the way to go.
Yeah. Buy now on low.
Well, that's good.
Buy now.
That's good.
Thanks, guys. Thank you, everybody.
Thank you.
Very good.
Thanks,
Thank
guys.
you.